Hey guys, my name is Dale Schlunt, and it is the middle of the year 2022. This is a time that allows us to look back at the last few years and take away perhaps some very unfortunate at times and also valuable lessons. This is especially true within the context of our economy. Think about over the past few years what drastic changes occurred within our economy. In 2019, the economy is growing relatively well. And then, of course, in 2020, the spring of 2020, COVID hits, businesses shut down for the obvious reasons. You have a ton of money coming in from your government to help us out. Then, post COVID, the last year or so, finally, the economy comes back and it comes back thriving, roaring back. And then, over the last few months, we've started to see, right, inflation become, just significant jumps, historical jumps we haven't seen in decades. Inflation hit it hit about 9% when it's supposed to be running closer to 2%. And as a result, your government has had to step in again to fix some of what they may have caused. And now we're talking about perhaps a recession in 2023. Hopefully that is something that can be avoided. And of course, over the last couple of days, we've seen that inflation may be at the very least peaking, but we still have a ways to go. There are some valuable lessons to take away from that. Right? On one hand, we probably all know what kind of economy we live in, a free market system. I'm sure you've heard about that, understand it, or a capitalist system. And all it means is that you have the ability to use that capital, right? And so money to invest in businesses, or individuals can use money to invest in equities, houses, whatever you want. You can use that at your discretion. And consequently, what does that lead to? It leads to the volatility in the overall economy. It means that those peaks, which by the way often turn into bubbles where speculation leads to things being overpriced, assets being overpriced, and also that leads to those economic downturns, recessions, or God forbid, depressions. We know that's an inherent part of our economy, and all of them are coming. There will be another bubble, great times, and recessions. Right? And as a result, your government has an active role to play in this. Their role in a free market system, or what is perhaps better defined as a mixed economy, is to allow for that freedom, but to influence it so you have greater moderation, to try and avoid those very large swings. Success, sometimes they have it to some degree, right? And oftentimes, as we all do, they misread an economy or make mistakes. And so we can see this using the study of the last few years, because those drastic moves occurred right before our very eyes. And we can use that to better navigate our economy in the future. Right? So let's look at this. One side of government is fiscal policy. Right? Basically, what that means is Congress, along with the presidency, they pass bills that become laws that allow for an influence in your economy, hopefully a positive one. Fiscal policy is, for the obvious reasons, much more ideologically driven. So, for instance, for conservatives, most subscribe to the idea of a supply-side economic policy. What that means is they prefer things such as tax cuts. Tax cuts would allow for a greater amount of capital to be used by businesses, not giving it to the government in the form of taxes, but instead using it to reinvest in their own businesses, hiring employees, for instance. And those employees would presumably go out and, now that they have a job, spend that pay in the economy, buying their significant other dinner, washing machine, what have you, new car. And that cycle would continue. Of course, on the other side, you have progressives that quite often believe in greater tax hikes. And they, in turn, believe that helps the economy by taking that money and investing it through subsidies to help stimulate, for instance, new sectors, new industries, what have you. Right? The problem is over every couple of years, that ideology, whoever is in control, they're going to implement their own ideology, right? And so it's perhaps less consistent, if not less dependable, than the other side of government that has an influence on our economy, and that is your Federal Reserve through monetary policy, referring to controlling to some degree the money supply. So we can see this in the form of interest rates. So your federal government, or rather your Federal Reserve, controls interest rates to either speed up or slow down an economy. Without getting too technical, they do this through the federal funds rate. So basically, they have an influence on how much banks charge each other to borrow money when they need quick liquidity, more money, right, in their institutions. And of course, that increase or decrease in how much they charge will lead to increases or decreases they would charge businesses, the public, on and on and on. The Federal Reserve controls this to a large degree, specifically short-term rates, but of course, they have an influence on longer-term ones as well. And so think about it. When COVID hit, the Federal Reserve essentially cut interest rates to basically zero. Right? What does that mean? It means that if I go out and I want to get a loan for a business, new car, perhaps even a mortgage, mortgages were in the 2% range. And of course, by the way, just a couple months ago, they hit 6% to make the overall point, the conclusion I'll get to. So they cut these interest rates to make it more appealing, because if I have a low interest rate, it's going to cost me less. I'll have to pay back less in interest, and I'll be more apt to go out and take out that loan. And what am I going to do with that loan? Of course, spend it in my economy. And therefore, from a broad macroeconomic perspective, that's going to stimulate our economy. We really needed that when COVID hit. On the fiscal side, as you all know, as well as I, it was so nice getting those checks. Our government passed a multitude of stimulus bills, right, that were meant to do things such as give a direct check to the American public, or I feel so old-fashioned, right? Maybe not a check, but of course, a deposit in your account, in addition to checks that went out. They also gave funding to state unemployment agencies, and that was, of course, going to put more money in the American public. This was very much needed in the early stages of the COVID pandemic. Right? Unfortunately, as government typically does, and as we mentioned, fiscal policy is many times much less reliable, they continued to pass these. Combine that with the monetary policy of lowering interest rates. People had tons of cash by the time we got to post-COVID, right? They also had pent-up demand. They were ready to spend that cash. So what is that the definition of? Inflation. That is the definition of inflation. Because when you look at the other side, the supply side, what you see is COVID disrupted supply chains, the ability for companies to get the materials they need to make enough product for those customers to buy it on that demand side. And so now you have an inequality of demand and supply, right? It's unbalanced. When you have too much money combined with the demand and not enough goods, that is a scenario for inflation. Think about it. What is inflation? It's essentially where it takes more money to buy the same amount or the same product it did a couple years ago, or any time frame you want. Inflation should be running around 2%. It's at 9%, coming down, just peaking. Basically, we're hoping very slowly. That is because the more money that is put into the system, the less valuable it is. Think about or at least why were diamonds so valuable throughout history, really? Why is that? It is because they are rare. The rarity. It's challenging to get enough, right? Combine that with demand, it means what? It costs more to buy it. That's the same thing with money, ladies and gentlemen, especially within a fiat system. The more you have out there, the less valuable it is. So you have to spend more of it to buy the same thing you did before. So, how does monetary policy address this? Now that we have all this money, which is so exciting, they raise the interest rates. And so think about it, 2% or 2 point something for a mortgage a couple years ago, we just hit about 5 and 6%. Which more are you likely to take out? A mortgage based on the 2% or the 6%? Obviously, right? Maybe you will second guess yourself. Think about that a little bit more before I go out and take out a loan for a higher interest rate, take on more debt on my credit cards, what have you, if I know I'm going to have to pay more for the same amount of money because they raised interest rates. So, what did we call that? Demand destruction. So, you are trying literally to slow down your economy so that if there's less demand, prices will come down. So, that product will meet the price, hopefully, that customers are now willing to pay, that lower price, presumably. Right? How effective is this? Well, we're finding out, right? And we will continue to do so. It has been done in the past, but the problem is, well, the analogy I would use is like a steak. Cooking a steak. You don't want to eat your steak raw. Imagine someone does, but most of us don't. You don't want to turn it into charcoal either. What do? Well, personally, I like medium rare. You want to cook it just enough to get the job done. That is what your Federal Reserve is doing. They are raising interest rates, hopefully just enough to slow that economy, bring down inflation. But if they turn it into charcoal, they can lead us into another recession. And so being able to not only understand how the free market aspects, the free market system elements of your economy work, what to look for, how to navigate that, being able to understand the influence your government has and to prepare based on that many times, that also allows you to navigate a whole nother facet of it. Combined, this hopefully allows you to have a greater understanding of your economy and perhaps a greater future financial success. Thanks.